Hi there, Mike Brady with Generosity Wealth Management, a comprehensive full-service wealth management firm headquartered right here in Boulder, Colorado. Today I want to do a first quarter review and a second quarter and rest of the year preview. Now, I'm a believer in diversification. If you haven't figured that out by watching my videos, then you haven't been paying attention. The reason why I like diversification, although in a generally declining market, it does not guarantee against losses, my experience has been that it does have a tendency to buffer or to dampen some of the high highs and the low lows, and it allows a client to stay with the plan that they have that works for them. I kind of think of, let's look at a portfolio, and this is kind of your break-even point. And if you have a very aggressive portfolio, you might have some real high highs. Everybody loves those. No one complains. But unfortunately, you might have some very low lows as well. So your band of returns on a quarterly, on a yearly basis could be, a very wide band around the break-even point. If you have a very low-risk one, you might not have very high highs. The top, the ceiling that you have might be very, very low. But then on the flip side, you're not going to lose very much as well. So you have a very, perhaps very narrow band right around the zero. There's no right answer. You've got to figure out what allows you to sleep well at night. And so some people, maybe this is the band for them. A lot of people, it might not be that. It might be a little bit closer to that. And diversification is one of the ways that you can create a portfolio and start to become comfortable with the risk tolerance level that you have. Okay. Now, this past quarter, in general, the large companies, the large values broke even to lost a little bit. And that's easily represented in the Dow Jones Industrial Average, one of the most common unmanaged stock market indexes. Small companies did a little bit better. And the big winner for the first quarter were those companies actually in the middle, those middle cap companies, those middle size, not real small, not real big, those just right in the middle. But equities are not everything, particularly U.S. equities. From a foreign point of view, that was a big winner. And so I believe that having a certain percentage in international stocks makes sense in an international stock fund for clients, some exposure that's, of course, dependent on your risk tolerance level. And so they were the big winners this year. In general, maybe 4 or 5% on the positive side. But equities are not everything. You also have bonds. Bonds in the first quarter were great to have in a portfolio because they increased your returns. 1 to 2% for the first quarter, depending on which bond category you were in. The way I like to think of it is here are stocks and here are bonds. You squish them together, and this is a portfolio. And sometimes stocks are going to lift the portfolio, and bonds might be a drag. Of course, on the other side, maybe bonds are going to be doing really well, and stocks are going to be a drag on the downside. In this case, that was the case. Stocks, the U.S. stocks, might have been a little bit on the high side. Here we go. Here's some stocks. U.S. stocks, just a little bit, sometimes a little drag, but the bonds did well for this particular quarter. Okay. In the first quarter, January was a negative month. February was a positive month. So if you miss February, you're really hurting for the quarter because that was really all of the gain. The only positive month of the three was February. You wanted to be invested in February because March we gave up just a little bit. Now, back in December, I did a video talking about the things that I look for to give me some early warning indicators, some leading indicators of some real problem. Because at the end of the day, that's what we're looking for. We're wondering if there's some big precipice, some big crevice that we're about to slide into. And every analyst, every investor has their own things that they're looking at. And good people can look at the same data and come to different conclusions. So I'm sharing with you some of the things that I look at. The first one is the S&P 500. It is the S&P 500 PE ratio. It's currently at 16.9. It has been increasing, which means that it's getting more expensive over the last year. And it's now at 16.9. I'm going to throw that up there on the screen so that you can see it, and I've even circled it to make it easier. A year ago, it was at 15.5. Just back in December, it was at 16.1. It is increasing. Not till it gets to about 20 am I going to really start freaking out. Corporate profits, you can see that They've decreased in the last quarter. I'm not super freaked out because I'm going to look for a continuation of that. So if we have 2 or 3 in a row, that'll be the real indicator that we might have some problems ahead. I'm going to throw another chart up there. I said in December, and I continue with it now, I'm really watching China. China is one of our large economies at this point. I mean, it's larger than the US even at this point, and it has right now been accelerating at about an 8.1% year over year. Their stock market was, without question, the big thing to be in this past quarter. But I personally think it is overvalued, and I don't really trust it. And even some of the numbers that come out of China, a lot of times I don't trust. That being said, I can't sit here and say this is absolutely wrong or that. It's just sort of a gut by some of my experiences working with international markets. I am going to continue to watch it with what is being reported, and I also take it with a grain of salt, their particular stock and the transparencies, etc. Interest rates. I said in December, I say it again, the yields are very low. When the yields start getting higher, that's a real problem. And that's because there's a huge correlation between the yield and the stock market participation. So that's something right now, it is still low. It's actually incredibly low. And that's one of the things that you're going to hear an awful lot about in the news in the next year. And frankly, we've been hearing it for 5 or 6 years now about how low interest rates are at this point. And that when the Fed starts to increase the rate, how horrible it's going to be for the stock market. And I just don't buy it. I'm putting up on the screen there 6 instances of the interest rate increases over the last 30 to 40 years. And it's kind of hard to see. I'm sorry about that, but because it's in white. But in general, you'll see that that's over a 1 to 2 year time frame. The green line and the blue line is what the S&P 500 did, the stock market, the unmanaged stock market index S&P 500, during rate hikes. So despite what you've been told, that when the rate hike starts, that the market, oh yeah, everybody agrees, and of course the thing's going to lose money, that hasn't been the case historically, although it could be this time. Okay, we don't know what the future holds. Nobody does. However, to say that blanket, to say that, oh yeah, the rate increase and therefore the stock market decreases, that hasn't been the case in the last 6 significant rate hike increases. You'll see that in the green. This is going all the way back into the early 1990s, over a 1 to 2 year time frame. Over a 1 to 2 year, the market has actually increased. So let's not jump off the ledge just yet. I am still optimistic because of all these things. I'm still optimistic for reasons such as the amount of money that's in the out there, kind of the M6 supply, I think is very high, so that's a great thing. So I am still optimistic and bullish versus bearish. And of course, I continue to believe in strong diversification. One thing before I end for today is I want to talk about volatility. People have said, oh my gosh, things are so volatile. Actually, it's been unbelievably unvolatile, non-volatile, I don't know what the word is there, over the last 2-3 years. I'm putting a chart up there, and I've circled some numbers. The red numbers at the bottom are the intra-year declines. That means from the top to the bottom throughout a year. So let's say it went up 10% in the first 3 months, hypothetically, and then it lost 9%. That would be a 9% intra-year decline. But let's say the year ended at 20%. Well, it had a 9% from the high to the low sometime during that year. That would be an intra-year decline. Well, last 3-4 years, they've all been single digits. I mean, this has actually been a very favorable market on the downside without a lot of 10-20% declines, which is actually normal, even though the year might end positive. So let's say the market went up 20-30% and gives up 10 or 15%. That 10 or 15% is actually normal within the year, an intra-year decline. So I do want to put some perspective on it. I mean, we have to prepare ourselves. We have to have a good portfolio, getting back that diversification. But with the Dow at over 18,000, give or take, 100 points, 200 points, just not as relevant as it used to be when the Dow was at 3, 4, 5, 6,000, even 10,000. So as a percentage, triple digit positive and triple digit on the down, which is what you see in the news, is not quite as relevant as it used to be a number of years ago. That is my first quarter review, my rest of the year preview. I am still optimistic. I am still bullish. I still believe in active management. I believe in diversification, and I believe in having personalized portfolios for each client. So, of course, talk with me if you need some help. And of course, if you're not one of my clients, talk with your advisor to find out what's right for you going forward. Anyway, Mike Brady, Generosity Wealth Management, 303-747-6455. Have a wonderful day. Bye-bye.